welcome to this budget special show where we'll analyze the economic survey that was presented by the Chief Economic Advisor Arvind Subramanian. Well, first, let's tell you the top highlights of this survey. The survey runs into 14 chapters and 335 pages. So this is just the first volume. The second volume will be released later this summer. But let's tell you the key highlights from volume 1 itself. The survey has pegged GDP growth in FY17 at between 6.5 and 6.75. Without demonetization, it would have been around 7.1%. As the chief statistician had stated, that is the CSO, the survey also estimates that the impact of the note ban or demonetization on the current year's GDP, therefore, is between 25 and 50 basis points. Second takeaway, the survey points out that growth in the next financial year will be worst case around 6.75 and best case 7.5%, as it expects low interest rates to boost the economy. Number 3, the survey has made a fervent pitch for sticking to the fiscal consolidation roadmap. It points out that fiscal activism may work in other countries like the United States, but it doesn't help India. Fiscal prudence works for India. The survey has an extensive 29-page chapter on the impact of demonetization. It admits that growth will be hit in the short term and informal sectors have been majorly impacted, but it also projects significant long-term benefits and expects a profound impact on the real estate space. It also calls for faster remonetization. Finally, the survey also makes the case for the much discussed universal basic income scheme as an alternative to various social welfare schemes currently underway. It says that the time is ripe for discussion, but implementation of a universal basic income scheme is still some distance away. It also estimates that the cost of basic income scheme will be 4 to 5% of total GDP, and hence the time has not yet arrived to implement it. Finally, the survey makes its case to bring land and real estate under the goods and services tax. It argues that this should be a natural follow-up to the landmark tax reform itself. Let's just briefly hear the Chief Economic Advisor on his growth outlook, and I'm going to return with a battery of excellent guests.
What is it for next year? Given the range we've given this year, I think we expect it to be in the 6.75%, 7.5% range for next year. I think the pickup, I think, as I said, the effect on GDP will be temporary. I think as remonetization happens, the economy will recover back to trend next year. Catch up in consumption as remonetization, a pickup in exports is something that can, get the economy back to trend next year.
All right, that's breaking news on last year's economic growth. So exactly how badly this demonetization is impacting the current year, we will get to know only by January next year. Nevertheless, some indications have been given by the Chief Economic Advisor, and to dissect some of his both analysis and statements are an eminent panel of experts who are joining me. Mazumdar-Shaw, the former director at the National Institute of Public Finance and Policy, Sajid Chinoy, chief economist at JP Morgan, Kiran Mazumdar-Shaw, the head of Biocon, and Richard Reiki, the head of KPMG India. Gentlemen and lady, thank you very much for joining me. Well, let me start with Sajid first. Sajid, do you think this is a candid acceptance of the short-term pain of demonetization? Nobody from the government has told us so far, or has had the courage perhaps to say, that 0.5% of GDP is gone.
That's right, Lata. Let me just step back and say this was an excellent economic survey, both in terms of substance and presentation. I think what was particularly noteworthy and encouraging was the survey went into extreme analytical detail to analyze the impact of demonetization. So it spoke at some length about the near-term monetary shock, spoke about all the channels of transmission, the demand shock, the supply shock, the impact and uncertainty, and did its very best, given the data limitations at hand, in terms of quantity. So I said, yes, it is an admission that there is a near-term growth shock. I think the numbers it lays out between 0.25% and 0.5% is very much in line with what most of us think. And even next year's GDP growth numbers of 6.75% and 7.5% are very realistic. It would have been very easy to get carried away and say, given that there's a near-term shock this year, there'll be a very sharp V-shaped recovery and growth can be much next year. The survey resisted that temptation. So all in all, I think a good analysis on the shock and very candid in terms of where growth prospects are this year, next year. So high marks to the survey.
Okay. Let me get to the more practical aspect of fiscal deficit. Dr. Govinda Rao, the survey, unlike previous surveys of the same chief economic advisor, is actually fiscally very prudent. Do you think this is a lesson learnt and that's the way to go?
Well, I'm not exactly sure. You see, when the reading of the chapter gives you a sort of a confused signal.
Oh, I see.
You know, I mean, on the one hand, is that the interest rate, growth rate differentials are much large, you know, I mean, growth rate is much higher than the interest rate in this country. And then, you know, it goes on and said, oh, but then we also have the primary deficit and therefore we have to adjust for that. But then, you know, there is no very clear picture of in the sense that what exactly his view on the fiscal consolidation. But maybe, I mean, I think it's a lesson learned. In that sense of the term, he doesn't, you know, sort of, he doesn't really pitch for a, you know, sort of large investments or large, you know, sort of public consumption based stimulus. In that sense, I think it's a good analysis, but you know, I mean, it's, you know, his view does not come out very clearly in this.
Okay. Well, time permitting, I'll come back and discuss the wisdom of continuing with fiscal prudence. He seemed to say that he's very staunchly in favor of the 2003 FRBM panel's advice, which was laying out a timetable to the fiscal deficit. So I read that as someone who is saying that fiscal prudence is better than fiscal profligacy. But I think the more important point is coming to the universal basic income scheme, where the chief economic advisor elucidates that the states are not, the states where there is maximum poverty, where there is maximum need to have income transfers or social welfare schemes, are least able, have the least economic bandwidth or administrative bandwidth to administer those schemes. And therefore, instead of wasting the money through various such schemes which are poorly administered by states which have poor administration, why not transfer the money by the center to the Jan Dhan accounts of the economically underprivileged? First on this, Kiran Mazumdar-Shaw, the idea itself is welcome, you think?
Well, you know, the universal basic income concept is absolutely very necessary for a country like India at the bottom of the pyramid. But I think, you know, it's going to be very expensive. I don't think we are prepared in terms of how to implement the scheme. And whilst it sounds simple to basically transfer, you know, cash to these Jan Dhan accounts, I'm not so sure that we are really fully prepared in terms of information and analytics to go ahead with the UBI scheme at this moment. But getting back to fiscal prudence, Lata, I personally believe that this is not time to rein in the fiscal deficit. I think we must try and really use this opportunity to invest in economic development. Today, we must make sure that the 200 urban growth centers that we have to be expanded. We have to multiply these number of growth centers, these urban growth centers. And the only way we can do it through huge investment in infrastructure, not just in terms of mobility and that kind of connectivity, but in terms of digital connectivity. This is an important opportunity that India has to go digital in many, many ways. But that will take a lot of investment in creating that digital infrastructure and the road and rail infrastructure that we need to take this growth out of urban centers that we have today. For a country like India, we cannot just rely on these 200 growth centers if we have to grow economically. And that is why I believe we must actually not try and rein in the fiscal deficit.
Okay, that actually starts the interesting part of the debate, Kiran. I thought I would get in the universal income scheme now. I'll discuss that latter part of this panel. But first, let me place the same argument to Richard Rekhi. Mr. Rekhi, actually, the survey itself states some meta challenges. They are almost philosophical, saying these are long-term transformations that we must, long-term problems which we must try and transform. And one of them, it says, is lack of state bandwidth. The government's bandwidth to deliver education or health is seriously challenged. This is a long-term problem which we have to transform, and this should cut across parties. Considering that the survey admits that the government so far has been incapable of delivering quality education or even quantity education, quality healthcare or even the quantity of healthcare, would you agree with Kiran?
I completely agree with Kiran. I think she has raised a very valid point. I think fiscal deficit, one should not rein it in. One should be open to have a range and to allow for investments to take place, which itself will help. It's like having good cholesterol and bad cholesterol. So I don't think we should get stuck on that number. India, huge investment. We have seen a fall in consumption. We have seen, the economy needs to be revved up. And I think we need some serious investments, infrastructure, digital. I mean, we are talking of digital payments, but is India digitally ready now to take on those payments? And this requires huge amount of investments into the economy in that sense. So I agree with her that we should not get stuck on number as long as it's going into investments. As long as it's going into investments and creating further income, I think it's the right step to take.
Okay, well, let me quickly get in Govinda Rao on this argument. Dr. Rao, no problem if there is a bit of 3.6 or 3.8% fiscal deficit, you think?
I disagree. I disagree completely, because I think we have been living beyond our means and we have been putting the burden on our future generation. Now, whether we need more investments? Yes. You can make more investment in two ways. Either raise more taxes or rein in your subsidies and transfers. You can't be just having both ways. Your subsidies and transfer, the total subsidy at the central level works out to almost 4% of GDP. Now, you don't want to touch them. And in fact, you see, fertilizer, transfer, for example, fertilizer subsidy is almost 75,000 crores. Now, we don't want to touch them. Your tax GDP ratio is stuck at 16.5%. We don't want to pay more taxes. Now, in this particular environment, what you do is get more, when your household sector's financial saving in this country, which is the only surplus available for investment, is 7.8%. Out of that, you take 3.5% at the center, you take about 3.5% at the state level, and another 2% is required by the public sector enterprises. You have preempted the money available for this thing.
Pointing.
Where is the money available for the private sector to make investment at all?
Dr. Rao, you're
what are we trying to do? Then, you start saying that the Reserve Bank should reduce the rate of interest.
No, Dr. Rao,
how can they reduce the rate of interest?
Dr. Rao, you're raising
Let us
a lot
understand the total macro scenario.
You made your point very effectively, Dr. Rao. We will have to let the others have their say. I just want to point out to one thing before I take a break. The survey has something called 8 interesting facts about India, and one of them is something which we should note. In countries like, at one end is Norway, and at the other end are countries, BRICS countries, countries like India and Turkey. In countries like Norway, Sweden, UK, etc., almost 100% of the voters are taxpayers. And in countries like India and Turkey, 100% voters and 7% taxpayers. The point is that since tax is paid by so few people, those who are spending it are not disciplined about the way they spend it. That point is made very interestingly by the survey. We're going to come and discuss these and other takeaways from the survey. In a minute, we have to take a break. Let's leave you with some more thoughts from the Chief Economic Advisor. Back in a jiffy.
Tentatively conclude that there will be an impact on GDP. The question is how much? For 2016, we expect real GDP growth to slow down by about 1/4 to 1/2 percentage point relative to the baseline. I think it's also fair to say that given the way GDP is measured in India, recorded GDP will underestimate the impact on the informal. This UBI, I think it's a very radical new idea, but Again, please do not misreport the survey as saying that the survey is advocating UBI. What the survey is saying is it's a very new, compelling idea. It has a lot of challenges. So it's an idea whose time is ripe for further deliberation and discussion, not necessarily for immediate implementation.
Demonetization has hit the Indian economic recovery. The growing consumption has been cash-strapped or shell-shocked, while India Inc. is sitting scared.
Can Budget 2017 cut taxes and leave a little more in the hands of the taxpayers in order to boost consumption?
Can the budget coax the companies to come out of their capex holiday and participate in the government-led projects?
Can Budget 2017 deliver some out-of-the-box solutions so that growth rhythm comes back? Find out on the Modi Stimulus, only on CNBC TV 18, your budget headquarters.
IRB presents the Modi Stimulus, Budget 2017, powered by Bandhan Bank. Bandhan Bank.
Title sponsor, IRB Infrastructure Developers Limited, Highway to Growth. Powered by Bank, Aapka Bhala, Sabki Bhalai. Insurance partner, LIC of India, Zindagi ke saath bhi, Zindagi ke baad bhi. In association with RP Sanjeev Goenka Group, Growing Legacies, Lloyd Air Conditioners, jo de khushiyon ki guarantee, and Toshiba for the next India.
Welcome back to this budget special. We are discussing the key takeaways from the economic survey. Before we went into this break, we had a very strong argument coming from Kiran Mazumdar-Shaw and Richard Reiki of KPMG that fiscal prudence is not the need of the need of the hour is to spend a little more so that India can be digitally and otherwise prepared for the development. Economist Govinda Rao strongly argues against fiscal prudence and preferred that if you want to spend more, then tax more efficiently. Let me just get Sajid's view, and then we are coming back to Kiran Shaw to have her word. Sajid, assuming the fiscal deficit does go to 3.5 or 3.6, my sense is that the government's behavior doesn't lead me to believe that. So far, they have stuck to fiscal prudence. But assuming it was 3.5 or 3.6, what will be the impact on stock markets? And more importantly, will the cost of money go up across for India Inc.?
So let me start with the caveat, Lata, that everything that we've seen about this government the last 3 years is that they do believe in fiscal prudence. They've taken tough choices in the last couple of years. So if there is a relaxation, I think it will be slowing the pace of fiscal consolidation, not abandoning it. But to your hypothetical question, yes, I don't think bond markets are prepared for the deficit to be 3.5 or 3.7. So what will happen is a couple of things. I think that makes it much harder for the RBI to cut interest rates. Knowing that the consolidated fiscal deficit in 2017-18 would be upwards of 7%, among the highest in the world, and that fiscal policy would be stimulative. So if you add that onto the fact that market interest rates have declined so sharply since demonetization, the worry would be there's too much stimulus in the system. So I think it's harder for the RBI to cut. Number two, I think the bond yield curve would steepen and steepen fully. The rest of the world has seen a steepening since November 8th. We've seen a flattening based in part because of expectations the fiscal will be more disciplined. But my bigger worry, Lata, apart from the near-term reaction on bond markets and equity markets, is I think if we've seen anything in the last 3 or 4 weeks globally, with the protectionism, with the trade scare, with the steepening of financial conditions, it is that 2017 is going to be a very tough year for emerging markets. You will not get the growth from advanced economies because of protectionism, but you may well get much tighter financial conditions. In that global environment, one would not advocate trading off macro stability for growth, because that will quickly translate into external imbalances and concerns about 2013, when India had a very large account deficit and we struggled to finance it, would come to the fore. So my worry about abandoning fiscal consolidation is not the 1 day or 1 week market reaction. It's the fact that if we abandon the tight fiscal, loose monetary of the last 3 years to go to looser fiscal, you could see more imbalances both domestically and externally, and an environment where we can least afford it.
Okay, well, we could go on a little longer on this. Kiran wants to come back on it, but I doubt we will have that much time. Kiran, the other question I wanted to ask you really is the survey making a very impassioned plea that real estate be brought into the GST calculation. Of course, they also want stamp duty cut. The point is, you have started this attack on black money. Take it to its logical conclusion. If you included GST, there will be a self-policing by economic actors to ensure that everyone has reported the correct price. There is no black money in the transaction of land. You think that's one of the worthwhile ideas we should take forward?
I certainly agree with that idea, Lata, because I think we do need to get far more transparent about our real estate transactions. And I think this is the right way to go. So I, for one, believe that that's a very, very good suggestion from our chief economic advisor in his economic survey. I just also wanted to take this opportunity to say that one area that we really need to focus on is investing in science and technology. We are very underinvested in science and technology. We are at, far below what other countries are doing at this point in time. And if we want non-linear growth of any sort, if we want to compete and stay aloft in this very challenging, world that we live in today with the kind of protectionism that's going on, we need to basically leverage our scientists and engineers to really, really innovate big time. And for that, if we don't invest in science and technology, which at the moment is about 0.8 to 0.9%, as compared to China's 3.5% or Korea's 4% and so on, we will not be able to really deliver on our talent pool.
Well, that point is taken. I guess everyone is worried about the removal of exemptions, and one of the big tax exemption given is to R&D. And yes, there is a lot of legitimate angst from industry that that encouragement, that minor tax encouragement to R&D should continue. That point is taken on board, Kiran. Well, Richard Rekhi.
And just one more point,
yeah, sure.
Lata. I just wanted to also suggest that, everyone's talking about corporate tax cut, but I believe that if there is any corporate tax cut, it should be linked to investment and job creation. I don't think we should arbitrarily reduce corporate tax rate. I think it must be linked to investment and job creation. Then it basically will realize some benefit to our economic growth.
Okay, well, it's always this police and the fact that things can be fudged or walked around that, scares one from such linking of tax cuts with job creation. But the overall principle is taken. Well, Richard Rekhi, we'll be running out of time. So one big idea for the budget on your part, be it job creation, be it fiscal deficit, be it universal basic income, on taxes, what's one big idea that you're expecting from the budget?
See, the one big idea is obviously, while Kiran has said corporate tax rates, cutting of the corporate, but I think tax rates need to be reduced and it should be accelerated because, and secondly, we should also see the consumption which is actually gone down. How do you actually put more money into the consumer's hands so that he can spend it? And I think there should be expenditure into the infrastructure and agriculture sector, which needs much more impetus. I think that investment needs to go in by the government, and that I think would be helpful from that point of view.
Okay, well, it's just that 2 plus 2 cannot add to 6, Richard Rekhi. If you have to have, put more income transfer so that people consume more investments and lower taxes, it doesn't add up, does it? Last thoughts, Govinda Rao, one big idea that you're expecting from the budget.
I think they should rationalize subsidies, particularly the fertilizer subsidy, which is actually a terrible thing. In fact, fertilizer subsidy goes to fertilizer companies. They should rationalize that, and that 75,000 crores should be given to research and development or capital investment in the country. In fact, much more needs to be done. And one of the interesting things, even if the cost of saying a little more.
No, Mr. Rao, only 10 seconds.
If they bring in the GST, the tax base of tax can go up. Tax base of income tax go up. More people will come into the tax net, and that could help in the medium term.
Okay, well, just last word from you, Sajid. Considering that the economic survey has admitted to lower growth, nominal growth of probably 10.75 this year and real growth of perhaps 6.5 to 6.75 as well next year, what is a legitimate tax growth that you will say is not wishful thinking? What should the tax revenue growth estimate be for next year?
So let's a couple of things. I think what the survey said was that any one-off taxes that you get, either from demonetization deposits or from an RBI dividend, should not be actually used for expenditure. So we won't count that as part of the tax base. I would say that if there's a tax buoyancy of 1 or 1.1 on a nominal GDP growth of, we'll be well placed. So I'd expect anything more than 1.1. I'll be a little more skeptical. This is without counting any tax rate changes. So if service taxes go up from 16 to 18% for the first 3 or 6 months before the GST, all of that will add to it. But excluding special measures like tax rate changes or demonetization benefit for the RBI, I think a tax buoyancy of 1 or 1.1, given the historical record, would be realistic.
So more than 12% growth in taxes should not be assumed by the government?
Net of any one-off changes or tax rate changes.
All right, let's see what we get from the budget. Kiran Mazumdar-Shaw, Richard Rekhi, Dr. Govinda Rao and Sajid, thank you very much for joining me in this special discussion on the economic survey. It's one of the written surveys, you will have to say. Thank you very much for joining us. We will see what the budget implements from this survey tomorrow.
Title sponsor, IRB Infrastructure Developers Limited, Highway to Growth. Powered by